Hi, it's Todd Unbehagen, president of Unbehagen Advisors. I'm here with Conan Raitt. He's our VP of Tax at Unbehagen Advisors, and Joe Russo, business law attorney, and we've been working with Joe for many years and have many mutual clients. So in this quick segment, we're going to talk about risk versus reward of a business owner. And just to start out, a lot of times business owners will come in and not understand their overall risk of purchasing or starting their own business. And I think if you look at it as an overall, let's say somebody's overall portfolio of assets and what they have, from money in the bank and their rental properties and stocks and things, you kind of have to look at owning a business as a risk, as an overall portfolio, right? So probably for the most part, most businesses are higher risk than, let's say, a money market that gets you 1%. So the idea is you're going to start a business, have a business, grow it. You've got more risk of default, and you just need to know that and be aware of that. So not everybody's the same. So how can we mitigate risk? When you have a business, you want to lower the risk of a business failing. I know we could talk about this probably for hours, but we just wanted just a brief introduction of people understanding what decisions they make that can help mitigate some of the risk of going into a business from a legal standpoint, and a little bit from a tiny bit from an accounting and tax standpoint. So Joe, go ahead and help us out with that.
Well, thanks, Todd. Well, as you know, we both of us, we see a lot of new companies. We put them together and we help business owners and entrepreneurs kind of establish an idea of risk versus reward with regard to starting to take that first step into business ownership. One of the things that and I had a client a couple of weeks ago kind of sit down with me, and it was very helpful for them because I gave them a different perspective on a lot of these risky things that are set, because that's my job, right? My job is your attorney is to watch your backside.
Absolutely.
Right? And so what you find a lot of times, especially for new companies that are just getting off the ground, there's a huge disparity in negotiating ability. So, for example, in this particular case, it was a distributor, and they're dealing with a manufacturer, and they're going to go ahead and distribute these products all over the place. And one of the things that they wanted me to look at was this agreement with this manufacturer, for example. And of course, you get this 50-page agreement, and it's very one-sided, and certain things we can go ahead and manage and change and redline perhaps. Mm-hmm. Certain things are the way they're going to be because there's a huge, like I said, disparity between negotiation between little guy and big company. Mm-hmm. And so you have to factor that in as far as your risk. Mm-hmm. Not only the cost associated with the startup of funds needed to do this properly, whether it's going to be distributing goods or whatever your business is going to be at the end of the day, you have to figure out that on the back end, you're in a very poor legal position as opposed to big manufacturer, big company, big client. Mm-hmm. And so you have to think twice, because if in fact something goes poorly within your scheme of business, there's not much recourse for you. Right? So that factors into your risk. And those are just a couple of the things and types of things that we kind of look at from my standpoint, and you at the same time from a financial analysis standpoint, that can help business owners make these decisions, because our job as trusted advisors is really to help educate you as a business owner so you can make a decision. I'm not going to go ahead and say this is a good decision or a bad decision. That's your decision at the end of the day. But I want you to have at least the tools in the toolbox to make the decision you're going to make.
Well, I think it comes down to confidence, right? So if a client's working with you or us, and we can give them as much information and that'll help them to make them go into that situation against that big adversary that basically could hurt them, and whether it's contracts, reviewing lease agreements. Right. I mean, one example easy example is landlord-tenant. You sign a lease, that lease is legally binding. Right. If you didn't review it and know what's in it, or know maybe what you can change to protect you, and you default on the lease, you could have major problems.
You could have major problems. Right. That's right.
And these are things people just sign without looking at it or having you review. And these are things that independent contractor agreements you can put together for clients that helps against contractor issues that can turn into thousands of dollars of legal fees for a small business.
Yeah.
Yeah, mitigated up front, right? Little cost up front.
Well,
for a lot of pain down the road potentially.
We tell from a contract standpoint, right? There's two purposes of a contract, right? One is to enforce the provisions, right? You want to get paid on your contract. What good is going ahead and entering into a contract if you can't get paid on it? That doesn't make any sense. And number two is to limit your liability associated with the contract, right? So those things that you try to go ahead and jump on up front, because at the end of the day, if things go south and you have to hire a litigant, that a litigation attorney is going to cost you a lot of money, right? And so if we can help avoid that, then we can, right?
And also, Joe, to form the entity properly. Not to get into that right now, but whether LLC or corporation, and then how that can relate to your tax savings as well. Right. Pairing those legal and tax side is critically important as well. Again, reducing your the amount you're paying out, and also reducing your risk from having limited liability in some of these entities is a good conversation to have, from the birth and beginning of a business, and then all the way through the business, the maturity phase, the growth and maturity phase, and then the sale needs to be managed as well to reduce your risk against anything that might happen legally, right?
Absolutely.
Okay. Mm-hmm. Well, great. Well, thanks a lot, Joe, and we'll talk to you soon. Thanks.
Thank you.